Over the years, I've read a lot of investing books, and the best ones all repeat the same hard lessons, usually learned the expensive way. So in this video, I'm sharing 6 of the best ideas from the books I've read, ideas I genuinely think everyone should know before putting their money into the market. But first, let's be clear. This isn't an investing tips or advice video. I'm not here to tell you what to buy, when to buy, or how to beat the market next week. And spoiler alert, rule number 6 is the one most people ignore, and it's exactly why they fail. Let's start with the first rule. Buy a business, not a stock. Most people don't buy businesses. They buy letters on a screen. They stare at charts. Green candles feel exciting. Red candles feel scary. And somewhere along the way, they forget there's an actual company behind that ticker symbol. So let me ask you something. If the stock market shut down tomorrow and stayed closed for 5 years, would you still feel good owning this? That question alone filters out most bad investments. Think of it this way. Buying a stock without understanding the business is like buying a restaurant because the sign looks cool. You didn't check the menu, you didn't see if people actually eat there. You bought it because you just like the vibe. But that's how most people invest. A real investor looks at a company and asks simple questions. How does this business make money? Who pays them? Why do customers keep coming back? And what could realistically destroy this business in the next 10 years? Notice how none of those questions involve the stock price. Successful investors chase durability. When you buy a business, you stop reacting to every headline. A bad quarter doesn't scare you. A market dip doesn't feel like an emergency. You know what you own. You know how it works. You know why it exists. And that mindset, that's where real investing begins. Rule number 2. Time in the market beats timing the market. Most people believe money gets made by perfect timing, buying right before a rally, selling right before a crash. Like investing is some kind of action movie where you jump in at the last second and walk away rich. But real life doesn't work like that. Let me give you a real example. In the early 2000s, right after the dot-com crash, the market looked absolutely broken. Headlines said stocks were dead. People swore they'd never invest again. And guess what? A lot of investors stayed out for years because they were waiting for things to feel safe. Those same people missed one of the strongest long-term growth periods in modern history. And then it happened again in 2008. Banks collapsing. The world felt like it was ending. Many investors sold everything or stayed on the sidelines. But the people who stayed invested or kept buying slowly during that chaos ended up seeing their portfolios multiply over the next decade. The market rewards endurance, not prediction. Let me ask you something honestly. Have you ever said, I'll invest once things settle down, and then watch the market run without you? That's the cost of waiting. The best investors don't look brave in the moment. They look stubborn, calm, almost boring. They decide early, I'm playing a long game, and then they stop reacting to every scary headline. So before you invest, ask yourself this, instead of trying to time anything. Can I stay invested when this gets uncomfortable? Because if you can't, timing will always tempt you, and timing almost always punishes you. Rule number 3, your biggest enemy is your own emotions. A few years ago, there was a regular guy named Mark, not a trader, not a finance nerd, just someone who finally decided to start investing. Mark did everything right at first. He read articles, watched videos, picked a few solid-looking stocks, and then something interesting happened. One of them started going up. A lot. Every day he opened his app and saw green. His confidence grew faster than the stock. He checked prices during lunch, then again at night. He started thinking, okay, maybe I'm actually good at this. So he added more money and took more risk. Then the stock dipped. At first, Mark stayed calm. It's just a pullback, he told himself. But the dip turned into a drop. The drop turned into panic. Suddenly, every red candle felt personal. One morning, after another bad day, Mark sold. Not because business collapsed, not because the fundamentals changed. He sold because he wanted the anxiety to stop. A few months later, that same stock recovered. Then it went higher than before. And that story plays out everywhere, all the time. Because the market is designed to mess with your head. Rising prices create confidence, falling prices create fear, and your brain reacts to both instantly, without asking permission. So, the real question is, how do I stop emotions from driving? Before you buy anything, write down why you're buying it and what would prove you wrong. Real reasons, not price moves. When fear shows up later, and it will, you don't argue with it. You check the plan. Another small change that helps a lot. Stop watching prices all day. Prices jump around, businesses don't. The less you stare at the screen, the quieter your emotions get. Rule number 4, demand a margin of safety. Imagine you're buying a used car. The seller says it's perfect, runs great, no issues, and then he asks for the same price as a brand new one. Would you feel comfortable buying it? Probably not, because there's no room for error. If anything goes wrong, you overpaid. That's the margin of safety. In investing, most people don't think like that. They see a company everyone loves, and they say, yeah, it's expensive, but it deserves it. That's not investing. That's paying full price and hoping nothing goes wrong. And something always goes wrong. Growth slows, costs rise, competition shows up, management makes a dumb decision. Not because the company is terrible, because the world isn't perfect. When you buy with a margin of safety, you're saying, even if things don't go exactly as planned, I'll be okay. Here's a real pattern you've probably noticed. When stocks are flying, people stop caring about price. They say things like, "This time is different," or "It's a long-term play." Then when reality hits, prices fall way faster than anyone expected. Why? Because expectations were stretched too tight. Let me ask you something important. If this company delivers good results instead of perfect results, does this still make sense? If the answer is no, you don't have a margin of safety. You have a hope strategy. Margin of safety doesn't mean waiting for a miracle bargain. It means refusing to overpay just because something feels popular or exciting. Because in investing, mistakes aren't rare. Fatal mistakes are. Rule number 5. Only invest where you have an edge. This rule takes a lot of pressure off once you truly accept it. You don't need to be good at everything to win in investing. You just need to be honest about what you actually understand. Most people think having an edge means secret information or complex models. It doesn't. An edge can be as simple as familiarity, experience, repetition. Think about something you already understand well. Maybe it's your job. Maybe it's a product you use every day. Maybe it's an industry you've watched for years without even realizing it. You notice small changes. You sense when something improves or gets worse. Other people miss that stuff. That's an edge. Now compare that to investing in something you barely understand, some complex tech, a trendy sector, or a business that needs 5 assumptions just to make sense. You don't feel confident. You constantly check prices. Every headline shakes you. Here's the trap most people fall into. They think, everyone's making money in this area, I should too. So they jump into things they can't explain. And when the price drops, they panic because they don't know why they bought it in the first place. Here's a rule that saves people from so many mistakes. If an investment needs perfect timing, constant monitoring, or complicated explanations, skip it. Simple ideas held for a long time beat clever ideas held for a short time. So instead of asking, what's the hottest opportunity right now, ask, where do I actually understand what's going on? Because when you invest where you have an edge, confidence feels calm, not forced. And investing starts feeling manageable. And that calm, that's usually where the edge really is. Rule number 6. Avoiding big losses matters more than chasing big gains. Most people focus on gains, big wins, home runs, the stock that doubles overnight. That's the story everyone loves to hear. But investing doesn't reward the fastest runner. It rewards the one who doesn't fall off the track. Let me put it this way. If you lose 50% of your money, you don't need 50% to recover. You need 100%. This is why avoiding big losses matters more than chasing big gains. Think about it like driving. You don't arrive faster by flooring the gas all the time. You arrive by not crashing. One accident ends the trip no matter how fast you were going before. We see this play out constantly. People take huge risks trying to get rich fast. Leverage, concentrated bets, all-in ideas. And sometimes it works for a while until it doesn't. And when it breaks hard. Let me ask you something. Would you rather make steady progress or risk starting over from zero? Your first job as an investor isn't to make money. It's to stay in the game. That means thinking about downside before upside, asking, what's the worst case scenario, before dreaming about best case outcomes. Big losses don't just hurt your portfolio. They mess with your confidence. They make you cautious at the wrong time. They push you out of the market when opportunities finally show up. That's why boring strategies often win. Think of compounding like a long road trip. Speed helps, sure, but one crash ends the journey. The investor who drives carefully might arrive slower, but they actually arrive. So next time you see an opportunity that promises massive upside, pause and ask yourself, what happens if I'm wrong? If the answer is, I'm out of the game, that's not an investment. That's a gamble. All right, let's zoom out for a second. None of these rules were about secret stocks. None of them told you what to buy next week. And that's the point. Because successful investing doesn't come from prediction. It comes from how you behave over time. If you think about it, all 6 rules connect to one idea. Buy real businesses. Give them time. Control your emotions. Pay a price that protects you. Stay within what you understand. And above all, don't blow yourself up. Imagine treating investing like a long hike, not a sprint. You pack carefully. You don't rush cliffs. You don't panic when the weather changes. You just keep moving forward. That's how compounding actually happens. So the next time you feel the urge to chase something hot or sell because things feel scary, pause. Come back to these rules. Ask better questions. Slow yourself down. Because investing doesn't reward excitement. It rewards patience, discipline, and staying in the game long enough for time to do its thing. And if you want to go deeper into where a lot of these ideas originally came from, I've already made a full video breaking down the book, The Intelligent Investor, why it still matters, and how to actually apply it in real life without getting lost in theory. Watch that next. It ties perfectly with everything we talked about today.